Hi everyone, today we'll be going over Accounts, May June 2021, Paper 2 question number 1. This is structured paper 2 and we have questions of total marks 90 and we also have a time limit of 90 minutes. Since question number 1 is of 30 marks, we will be attempting to solve this question under 30 minutes. So let's get started. N Limited is a trading business and sales are made on the credit basis only. So there are no cash sales and we're given the information available at 31st December 2020. We're also given additional information relating to administrative expenses, depreciation, credit customers, and then debenture interest. Let's have a look at the question first. We need to prepare the company's income statement for the year ended 31st December 2020. So whenever we are preparing an income statement, we always start with the revenue. So let's write that down first. Now for the value of revenue, we have to look for it in the given information. So revenue is given right here and it amounts to 923,000. So let's write that down. Secondly, we subtract the cost of sales from the revenue in order to figure out the gross profit. Let's write that down as well. Let's look for the value of the cost of sales in the given information. Cost of sales is given right here. So it has the value of 466,000. We're just going to substitute this value into the income statement now. Now we can easily figure out the gross profit amount. That will be 923 minus 466, which gives us 457,000. Okay, after gross profit, we subtract all of the other overheads. Firstly, we can write it down as administrative expenses. Now let's have a look at the given information to figure out which of these expenses should be included here. The first one is administrative expenses given right here. That amounts to 171,000. Then we also had additional information relating to administrative expenses. Administrative expenses included insurance of 16,000 for 4 months ended 31st January 2021. So we are preparing the income statement for the year ended 31st December 2020, which means that all of the expenses should be in between the dates of 1st January 2020 and 31st December 2020. But we are told that the administrative expenses include insurance 16,000 for 4 months ended 31st January 2021, which means that this includes insurance cost for 1 extra month, which should not have been included in the income statement for the year ended 31st December 2021. So let's just figure out the insurance per month first. So insurance per month is just going to be 16,000 divided by 4 because it clearly states that 16,000 was the expense for 4 months. Now the insurance per month is just going to be 4,000. So there is an additional 4,000 included in the administrative expenses, which should not have been included. So we need to subtract 4,000, right? We completed this information. Let's have a look at the second one. Depreciation should be provided on non-current assets at 25% per annum using reducing balance method. All right, then the depreciation charges should be allocated 20% to distribution costs and 80% to administrative. So we need to figure out the total depreciation charge, and then 80% of that charge should be included in the administrative expenses. Let's figure out the depreciation for the year. We are calculating depreciation using the reducing balance method. So we need to use both the cost and provision for depreciation, which is given right here. So that's 1,140 and then 140. We just figure out the net book value. In order to do so, we subtract the provision for depreciation from cost, which is going to be 1,140 minus 140. That will be the net book value, and we multiply it with the rate. And the rate is 25%, so we can just multiply it with 0.25. This gives us the depreciation charge to be 250. Now, out of this 250, 80% should be included in the administrative expenses. All right, let's look for any other information. Okay, the third one relates to the account of a credit customer, 3,000. This should be written off to administrative expenses. So 3,000 is just a bad debt, and this should be included in the administrative expenses as well. All right, we will do that. And then the fourth one is that the debenture interest. So debenture interest is not included in the administrative expenses. We can completely ignore this. So we have 4 items that should be included. The first one is the amount given in the information as 171,000. Second one is that we should exclude the 4,000 relating to the first month of the year 2021. Then we have to allocate the depreciation in the administrative expenses, but only 80%. And another one is a bad debt. So let's just calculate the total amount first. We have the workings given right here. So for administrative expenses, that's going to be 171,000 given in the information. Then we need to exclude the 4,000, so that's minus 4. We need to add the 3,000 for bad debt, so that's plus 3. And we need to add 80% of the depreciation. Total depreciation was 250, so the 80%, we can just multiply it with 0.80. Now this gives us the total administrative charge to be 370. That's 1,000. Let's include this value right here. That's going to be 370. Nextly, we can move on to the distribution costs. Let's look for the items that should be included in this. So the first one is going to be distribution cost given right here. This amounts to 63,000. Second one we have is 20% of the depreciation should be allocated to distribution cost given right here. So we also need to include this one. And I don't think there's any other information relating to distribution cost. So that will be it. These 2 information. Let's figure out the total first. So the distribution cost given in the information section was 63,000. And we also need to add 20% of the depreciation charge. So that's going to be 250 into 0.20. This gives us the total distribution cost to be 113,000. So we just substitute this value to the income statement. Now finally, we can figure out the profit or loss from operations. So we can see that this combined value is obviously greater than the gross profit, so it results in a loss. So we can just write it down as loss from operations. That's 457 minus 370 minus 113, which gives us the loss to be 26,000. That's a negative, so we put it in a bracket. Nextly, we subtract the finance charges or finance cost. Let's look at the information to figure out what should be included. Finance costs includes all of the interest charges, right? So the first one we can include is the debenture interest given right here. This amounts to 8,000. Now there was an additional information relating to debenture. Debenture interest was outstanding for the second half of the year, which means that whatever debenture interest we paid above, that amounted to 8,000. This 8,000 relates to the first 6 months, but we need to include the interest for the entire year, meaning that the second half of the year debenture interest was outstanding, and if the first half of the year has a debenture interest of 8,000, then the second half will also have the same amount. So we need to add another 8,000. This results in the total debenture interest for the year. Then the directors had issued additional debentures of 50,000 on 1 October 2020. So let's have a look at the debenture first. We're given the debentures to be of 8%, meaning that we pay 8% interest on the debentures that the company took. So we will be charging 8% interest on this new debenture of 50,000 as well. But we only charge the interest for this particular year ended 31st December 2020, and we can see that the debentures had been issued on 1st October 2020. So the number of months in which the interest should be charged is just going to be October, November, and December. So that's 3 months. All right, let's figure out the total interest first. That's going to be 8,000, which had already been paid for the first 6 months, and another 8,000 for the second 6 months of the year, and then we issued new debenture, 50,000. The interest should be charged at 8%, so we can just multiply it with 0.08. Now this gives the debenture interest for an entire year, but since the debenture was issued on 1st October 2020, we only need to charge the interest for 3 months. So we can just multiply it with 3 by 12. This is a very simple unitary method. Now this gives the total finance cost to be 17,000. So we can just substitute this value in the income statement. Now, since we have loss from operations and we again have to subtract finance costs, it is very clear that we have to bear a loss for the year. We can just write that down. So the loss is going to be minus 26 minus 17, which results in a loss of 43,000. This completes the income statement and the first part of the question. Let's move on to the second one. We are given an additional information. On 1st July 2020, the directors had decided to make a rights issue of 2 ordinary shares for every 3 shares held at a price of 0.30 per share. Alright, and then the rights issue was fully subscribed. We need to explain 2 reasons why a company may make a right issue of shares rather than an issue of debentures. So the very first reason is that rights issue is a permanent source of capital, but in case of debentures, they are a liability and that must be paid at a future date. That would be the very first reason. Let's write that down. So rights issue is a permanent source of capital, whereas debentures are a liability that must be repaid at a future date. Now, the second reason is that on any kinds of shares, be it ordinary share or right share, an investor expects a return, and that return is given in the form of dividends. Dividends are a part of the distributable profit, right? But in case of debentures, we need to pay the interest as we calculated in the above part as well. So these interest payments reduces the profit for the year. That would be the second reason. Let's write it down. Dividends are paid on right shares, but debentures require interest payments that reduces profit. Alright, this completes the second part. Let's move on to the third one. We need to calculate the amount raised by the rights issue. Alright, first let's have a look at the given information. We have the total issued capital amounting to 500,000 of 0.25 each. So the nominal value is 0.25. Let's write that down. So the value of ordinary shares is 500,000. And we're given the additional information relating to rights issue that they made the rights issue of 2 ordinary shares for every 3 shares held at a price of 0.30. So the rights issue was made on premium, right? But what we need to know here is that this rights issue was made on 1st July 2020, and this value of ordinary shares is on 31st December 2020. Which means that this value of the ordinary shares already includes the rights issue as well. This might sound a little confusing, but I will try my best to explain it in the easiest possible way. Now we need to calculate the number of ordinary shares. In order to do so, we just divide the total value of the ordinary shares with the nominal rate. So the total value is 500,000 and the nominal rate is 0.25. So this gives us the number of ordinary shares to be 2 million. Now initially what we know is that for every 3 ordinary shares, we are given 2 right shares. But in this number of ordinary shares, it already includes the right share as well. So we need to include the right share here as well. This means that for every 3 plus 2 ordinary shares, because we are also including the number of right shares, there will be 2 right shares, right? So this just means that for every 5 ordinary shares, there are going to be 2 right shares. Now, we'll use a simple unitary method. So for every 1 ordinary shares, there are going to be 2 by 5 right shares. Now we will figure out the total number of right shares out of these ordinary shares. So for 2 million ordinary shares, there is going to be 2 by 5 into 2 million right shares. Now if you calculate it, we will obtain 800,000 right shares per 2 million ordinary shares. But we need to figure out the amount raised by the rights issue. So let's figure that out first. Now in order to figure out the amount raised by rights issue, we can just multiply the total number of rights issue with the amount in which these right shares were issued. So we know that the right shares were issued at a premium with a value of 0.30. So that's just going to be 800,000 into the value 0.30. This gives us the total amount raised by the rights issue to be 240,000. This concludes the third part of this question. Let's move on to the fourth one. We need to prepare a statement of changes in equity for the year ended 31st December 2020. What we need to realize is most of the information given in the question is relating to the balance at 31st December 2020. So let's first write that down. We can write it right here. So that's going to be balance at 31st December 2020. We know that the ordinary share capital had the value 500 because we just calculated it in the above part. Let's look for the values of share premium and retained earnings. So share premium is also given at the date of 31st December 2020 and it has a value of 70,000. But retained earnings is given at the date 1st January 2020 and it has a value 129. Let's first write these values in the statement of changes in equity. So the share premium had the balance of 70,000 at the end date and retained earnings had the balance 129 at the beginning date. Now we need to fill up whatever events that took place in between these dates relating to the equity. So the first one is we always add the profit for the year to the retained earnings and we deduct loss for the year from the retained earnings. And if you remember from the first part, we calculated loss for the year. So let's write that first. Let's look at the value of the loss that we calculated. Loss was of 43,000. So we need to deduct this 43,000 from the retained earnings section. So that's going to be a negative 43, and the total will also be negative 43. There's not going to be any changes in the ordinary share capital and share premium because of the loss for the year. Nextly, we can write about the rights issue. Let's write that down. So we figured out the number of shares issued as right shares to be 800,000. But these were issued at the value of 0.30, whereas the ordinary share capital has the nominal rate of 0.25. So only the values of 0.25 out of these 800,000 shares should be included in the ordinary share, and the remaining 0.05 should be included in the share premium section. Let's first calculate that. So for the ordinary shares, that's going to be 800,000 into 0.25. So this gives the value for the ordinary shares to be 200,000. Then the remaining value would be 800,000 into 0.05. That goes to the section of the share premium with the total value of 40,000. Let's write that down. So rights issue will have 200, share premium will have 40, which results in the total rights issue to have the value of 240,000. All right. Let's look for any other terms that should be included. So we have dividends paid right here. So dividends paid is always deducted from the retained earnings section because dividends are a part of distributable profit, which is recorded at the retained earnings. And we have the value of dividend paid to be 80,000. So let's just deduct that from the retained earnings section. So it's not going to have any effect on the ordinary share capital and share premium. We're just going to deduct the 80,000 from the retained earnings. Now, these are the three events that took place between 1st January 2020 and 31st December 2020, which relates to the equity part. So we can just find the total and figure out the missing terms in this statement. So for retained earnings, we can find the balance at 31st December 2020 by adding these three values. So that's 129 minus 43 minus 80, which gives the balance to be 6,000. So we can just add up these three values in order to figure out this total. So that's going to be 500 plus 70 plus 6, which gives us the total value of 576. Now, if you look at the ordinary share capital, this balance here acts as the balancing figure. So in order to figure this one out, we can just subtract 200 from the total value of 500. So that's going to be 500 minus 200, which gives the balance at the opening date to be 300. We can repeat the same process for the share premium as well. We can subtract 40 from the final balance of 70. So that results in the balance at 1st January 2020 to be 30. Now, in order to figure out this total, we can just add up these three values. So that's going to be 300 plus 30 plus 129, which results in 459. So if we need to check if we did it correctly or not, we can just add these values and see if it produces the total of 576. As you can see, it clearly does. So this statement of changes in equity is correct. This completes the fourth part. Let's move on to the fifth one. We are given another additional information. The directors are concerned about the company's credit control and wish to improve the company's liquidity position. So they are considering a proposal to offer 5% cash discount to customers for settlement within 30 days on all invoices of more than 2,000. Now we need to identify two ratios which can be used to assess the liquidity of a business. So if we are to see the liquidity of a business, there are basically two liquidity ratios known as the current ratio and the quick ratio. So we can just write it down. The first one is current ratio. It figures out the relationship between the current assets and the current liabilities. And the next one is quick ratio. So quick ratio measures the relationship between quick assets and the current liabilities. It is also known as acid test ratio. This concludes the fifth part. Let's move on to the sixth one. We need to advise the directors whether or not they should go ahead with the proposal. We need to justify our answer. First, let's have a look again at this proposal. So the proposal was that they will offer a 5% cash discount to customers for settlement within 30 days on all invoices of more than 2,000. So obviously this might improve the cash flows because it encourages the customers to pay quickly. That will be our first point. Let's write it down. May improve the cash flows as it might encourage the customers to pay quickly. Nextly, discounts allowed will reduce the profit because we are essentially cutting down our income by providing a discount to the customers for a prompt payment. And we clearly worked out that the company is going through a loss. So if we're providing more discounts, then the company will have to bear more loss. Let's write that down as well. But the discount allowed will reduce the profit and the company is already making a loss. Now, thirdly, this proposal states that only the customers having invoices greater than 2,000 are liable to this cash discount of 5%. So maybe the customers having invoices less than 2,000 might be offended with this decision of the company and may choose to buy their products from another supplier or another company. So that might reduce the customer base for our company, resulting in this proposal to go in a very bad way. Let's write this point as well. Customers having invoices less than 2,000 might not like this decision, resulting in a possible loss of customers. So from these points, we can clearly make out our decision that the directors should not go ahead with this proposal. Let's write our decision clearly. The directors should not go ahead with this proposal. Alright, this concludes the sixth part of this question as well as this question. If you found this video useful, make sure you leave a like below and leave a comment as well. Make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.